This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, back in our introductory lecture to this chapter, we saw all the basics that we needed to know to be able to prepare the corporation tax computation, knowing what period we would be preparing it for. And now we come, therefore, to that detailed preparation of the corporate tax computation. It, as with any tax computation, as we said in that introduction, comes in two parts. The first idea is to compute what is chargeable to tax, and then the second part of the computation is to establish the tax charge thereon. So what we've got to do with our computation to begin with, once we've determined the period for which it is to be prepared, is to establish the taxable total profit of that period. Once done, we can then proceed to tax it, which of course on this occasion, as we learnt last time, is going to be very, very easy indeed, because all of our TTP, once computed, will be chargeable at a single 19% rate of corporate tax. So what I've got here, therefore, in section 2 in chapter 16. The company's corporation tax liability for an accounting period is calculated by computing the profits, and that is worldwide income and gains, from all sources, worldwide income and gains. That will bring us down to something called total profits there, total profits, and then deducting qualifying charitable donations. Companies do get a more simplified version of tax relief as compared to individuals. With individuals, we saw about the gift aid system and how that worked, and that had complications as regards the preparation of the income tax computation. Here, not so. What we will have is qualifying charitable deductions, donations that are paid that will be deductible, in deriving the taxable total profit at the bottom of this corporate tax, or first part of this corporate tax computation. But again, watch for wordings, very specifically in terms of Section A objective testing questions. Taxable total profits will be the figure after deducting qualifying charitable donations. Total profits is the figure before deducting those donations. Those total profits are made up, of course, of all the sources of taxable worldwide income and gains, and all the usual suspects, with one major exception that we noted last time, but all the usual things that we saw within an income tax computation will feature here within the corporate tax computation. All we need to know is the basis of including them within the corporate tax computation where appropriate. So yeah, once we've established total profit, the summation of worldwide taxable income and gains, take away the qualifying charitable donations. That figure will be on a paid basis and will be given within the exam question, of course. That gives us TTP. It'll then be an easy process of taxing that TTP at 19%. What does the corporate tax computation look like? As we've said, we prepare it for an accounting period. Remember, the question gives you the statement of profit or loss. That is the company's period of account. As long as it does not exceed 12 months, it becomes the accounting period, and therefore the period for which the corporate tax computation is prepared. So we've got here a corporation tax computation for the year ended 31st of March 21. So presuming the company prepared its accounts for that self-same period, the period of account was the year ended March 21. It becomes the accounting period, therefore the period of which we prepare the corporate tax comp. And not that it would matter these days, but all of that period, the year ended March 21, is within one financial year, FY financial year 2020. Therefore, as it would be anyway, a single rate of corporate tax, i.e. 19%, will apply. Now, where will a business here, a company, get most of its income from? And that, of course, is from its trading operations. And hope you have revised through chapter 4 to deal with the adjustment of profit to give you an adjusted profit figure. Before that is the deduction of capital allowances. For that, you had to refer back to Chapter 5. Having got the capital allowances for this accounting period, we take those from the adjusted profit figure, and that will give us the tax adjusted trading profit, or potentially even tax adjusted trading loss. If it were a loss, then you would have a nil assessment rather than a profit figure to go in. We never put a negative figure of the loss figure in the corporate tax computation. If it is a loss figure, whether £1 or £1,000,000, it is a nil assessment there. And we separately deal with the choice of loss reliefs that would be available and try to get the best use of that loss for the company. As we said, that's going to be the majority if, for example, as we know, corporate tax is the second biggest of the taxes within our syllabus, there next to income tax. And it is so important that in section C, where the written questions are, we know we got a guaranteed 15-mark written question on income tax, and we've got a guaranteed 15-mark written question on corporate tax as well. Now, that doesn't always entail the preparation of the full-blown pro forma corporate tax computation. It might deal with losses, for example, there, and loss reliefs being applied, rather than just the specific content of the corporate tax computation. But this is, again, more likely to be the main object of questioning within that 15-mark question. So we have to know, therefore, how to deal with an adjustment of profit for the incorporated trader, as well as what we've already seen in Chapter 4 for the unincorporated trader, and how to prepare the capital allowance computation for the self-same accounting period, again, for the company rather than the unincorporated trader. And that will therefore give us our tax-adjusted trading profit, if there is one. Now, as regards the calculation of those profits, then, as we see there, that's what we've just shown on the face of the computation. The issue about the adjustment of profits, mostly it's as per Chapter 4 for our unincorporated business. Similar, but not exactly the same. For incorporated businesses, we've now got to look at what those differences are. The main differences are, as we said, if you recall in our introductory previous lecture to corporate tax, there's no private element of expenses to be added back, as there's no private use by the proprietor. There is no proprietor there. So where you'd see private use, that private use on things like motor expenses, where the car is being expensed through the unincorporated business. There's no private use issue here. The individual was living in a property above the shop that they ran, and therefore rent and rates, electricity, other various running expenses of a property were partly private and partly business. None of that is going to be an issue here. There's no private use issue. There's no proprietor. The owners of the business will be shareholders. If it's an owner-managed business, then they will be employees. And if they are provided with benefits as an employee, then there will be an assessment under the employment income rules that we saw back in Chapter 9. So no private use issues, and that, as we'll see in a moment, is equally applicable in terms of capital allowances. Again, basic rules as per the unincorporated business, but there's no private use assets, so there's no adjustment for private use by a proprietor. That was probably one of the more awkward things to deal with indeed back in income tax and Chapter 5 for capital allowances for the unincorporated trader. And also, this won't be an issue at the moment, but will be an issue when you come to Chapter 22 to deal with groups of companies rather than just here single companies. And that is to note that only one AIA is allowable to a group of companies. You do not get the full 1 million AIA for each company within a group. It will be divided between the companies within that group. But as we'll discover in Chapter 22, there is flexibility there because you choose how to divide that between the group companies. You, the parent company there, will make that decision. Just going back though to the basic adjustment of profits, other than depreciation added back, let's do the capital allowance computation. There's no private use issues on expenses, as we've said. As there's no proprietor, therefore there's no drawings issue, there's no goods taken for personal consumption there. That is again not relevant as there's no proprietor. If an individual owner of a business, owner of a company, is also an employee, then salaries or benefits provided to business owners who work within the company are assessed, as we've just said, as employment income on the individual. Then such salaries or wages paid to employees of the company will be allowable deductions for the company. Owners, of course, own shares in the company, and on shares may receive dividends. Now, any distributions, i.e. dividends paid to shareholders, are not allowable deductions and are paid out of post-tax profit. We made the point that dividend income was exempt from corporation tax, and the basic logic behind that is that one company has made a profit, it has been charged to tax on that profit, and out of the tax profit, the distributable profit, has then paid a dividend to another company. Therefore, HMRC are kind enough not to tax that income again in the hands of the recipient company. So dividend income is exempt. Again, remember, dividends are distributions out of tax profits. They are not expenses to be deducted in deriving that taxable profit. Family salaries, again, where you paid to a member of your family above a normal commercial rate for the job that they did, irrelevant in terms of corporate tax. There are no family salaries. Legal fees, again, always an issue about legal fees. Was it a revenue expense or was it a capital expense? That was the issue. Well, here, of course, this is a company. So regarding the issue of share capital, obviously unincorporated traders don't have share capital. It's not an issue there. But it is for companies, only for companies. And as they are of a capital nature, the expense, of course, is disallowed. And anything you disallow is added back in your adjustment of profit process. Legal fees with regard to registering patents and trademarks are allowable by statute. Again, anything to do with trading is clearly, therefore, going to be a trading expense and will be allowable. Interest payable. Now that's going to be, no pun intended of course here, a very interesting item indeed for our corporate tax computation. And interest payable on a non-trading loan will be disallowed. If it's disallowed, it's added back in the adjustment of profit. I.e., we're only going to give tax relief on interest payable in the trading income part of this exercise for a trading loan. Now think, why might a company have borrowed money upon which they're paying interest? You'd think in most cases it would be for a trading purpose. We are borrowed to buy a factory, a warehouse, business offices. Again, that is a trading business. That's again part of our trading. So interest payable in relation to, again, buying an asset for use within the trade, a property, for example, or plant and machinery. Again, if we pay interest on a loan taken out to buy plant and machinery, that is a trading operation, the use of the plant and machinery in the trade, and on that basis is allowable. If we borrow to increase working capital, again, all of those are trading purposes. Buying assets to use within the business, increase working capital, those are trading loans. Any such interest payable, along with your normal overdraft interest on your current account there for your normal trading operations, all of that is allowable. But non-trading loans, clearly the clue's in the name, they are not trading, then clearly they will not be allowable deductions in deriving the trading income. So if you're starting the adjustment of profit process with an accounting profit at the bottom of your statement of profit or loss for the company, And we've already deducted in deriving that figure all of the interest payable, both on trading loans and non-trading loans. Anything that is non-trading is disallowed and therefore is added back. However, what we do with that non-trading loan interest payable is indeed, again, we keep the pun going, interesting. And that is that the expense is deductible instead against interest income. And that is going to be the case whatever the non-trading loan may be. Now don't worry, we've got a further note on interest income in this chapter in just a short while. And we'll see the typical examples of non-trading loans where that would be picked up. You might also pay interest to HMRC, again on underpaid tax, on late paid tax. You have to pay interest. Now in income tax we learnt that any such interest payments did not achieve tax relief for the individual, and any such repayment supplements were not taxable income. That is different when it comes to companies. So interest payable to HMRC is non-trading, but is tax relievable, but again against interest income. So it's not going to be allowed against trading income, but it will be an allowable deduction against interest income. So in deriving your bottom line TTP, yeah, tax relief will be given, but it is important to note that is in deriving the interest income assessment, not the trading income assessment. Equivalently, interest receivable from HMRC is taxable as interest income. Though given the rate, of course, of interest, that's going to be very minimal, of course, indeed. So the vast majority of what we do in adjustment of profits is going to be the same as we dealt with for income tax. Again, what they often do, of course, is to put elements of private use by the owner of that particular company into the example to see whether you'll bite at that. Don't. We know there's no private use issues, not in adjustment of profits, not in capital allowances, when it comes to dealing with companies. Well, up until the Finance Act of 2021, the capital allowances computation that you put together for a company in corporate tax would have looked almost the same as it did for the unincorporated trader. There was but one exception. Now that exception still remains, but we've got a whole load of new interesting stuff to deal with now based on what the Finance Act 2021 introduced purely in corporate tax for companies in the form of enhanced capital allowances, as they are known. So what have we got? Your basic capital allowance rules here for an unincorporated business, which we saw back in chapter 5, of course, there, have previously always applied to companies as well, with the exception that there are no private use assets. We don't have private use in corporate tax. We only have it in income tax, where it is by the proprietor there of that unincorporated business, not where there is private use by an employee. And in terms of companies, everyone will be an employee, whether they're also owners of it and have shares or not. It doesn't matter, they will be employees, and therefore there will be no private use assets, like there'll be no private use adjustments in relation to the adjustment of profits. There's no private use assets. That, therefore, is always been the case, and it remains true now. Also, what remains true, but you wouldn't have known about it until now, is that there's only one AIA, up to, of course, your £1 million limit, which is for a 12-month accounting period, but only one allowable to a group of companies. So you can't have a company that is regularly spending in excess of the AIA limit, currently, of course, £1 million, then deciding, well, we'd like, therefore, to get more AIA, so what we'll do, we'll split the operations into two separate companies, parent company and subsidiary, or we go parent and two subsidiaries and divide it out, in the hope that each of the 2 or 3 companies would then have an AIA limit of £1 million for a 12-month accounting period. Well, that's not going to happen. it's only one AIA within a group of companies. Now that's dealt with in Chapter 22, so that's a little bit later on in our studies there when we deal with the specifics of groups. But what has happened in the Finance Act of 2021? And here's the bit now that's relevant for us. For a 2-year period from 1st of April 21 to March 23, companies can benefit from enhanced capital allowances. It will only, however, be available on the purchase of new plant and machinery. And it's available for expenditure that would fall into the main pool and would otherwise attract the AIA. So anything that was main pool expenditure that would otherwise have attracted the AIA, so not things, of course, like cars there, then there's 130% super deduction FYA that is now available instead. Now remember, this is only available for new plant and machinery, not second-hand plant and machinery. But this is great news. Instead of using up some of your precious £1 million AIA limit in relation to such expenditure, we've got a better claim. Why take 100% when you can have 130%? Great news, therefore. I can spend £1 million, £2 million, £3 million and get 130% deduction. Again, any other rules, specific rules and limitations surrounding all of this legislation is outside of your syllabus. But you would be able to get 130%. You're going to make that claim there. Okay. Again, a very obvious statement, but yes, for every £100,000 of expenditure, therefore, that qualified, a first-year allowance of £130,000 would be available. Now, again, as we've said, this enhanced capital allowance, this FYA of 130%, only available on expenditure on new plant and machinery that qualifies, not expenditure on second-hand assets. In addition, of course, that hasn't changed. Motor cars do not qualify for AIA. They do not qualify for that super deduction, the 130% FYA. But of course, we do get an FYA, the same rules as we have for unincorporated traders, for zero emission cars. They get, whether it's unincorporated or incorporated trade, it doesn't matter, the 100% FYA is available in relation to zero emission cars. For expenditure which would fall into the special rate pool, again, you need to know your list of expenditure that is special rate pool expenditure, then there is a 50% first year allowance. Now that's great, but it isn't the first thing you're going to go for. Remember, there's very little expenditure left apart from special rate pool expenditure that would now go into an AIA claim. The vast majority, probably all of your otherwise AIA qualifying expenditure on normal plant and machinery is now not going to have AIA. It's going to have instead the 130% FYA. So what will happen here is that the effect is that the special rate pool expenditure should firstly attract AIA, because you'd rather have 100% AIA than the 50% FYA. Now this, of course, is only going to be an issue in relation to where you have expenditure in excess of that AIA limit. Again, I repeat, the £1 million for a 12-month accounting period. Remember, from what we've already seen here, when we prepare a corporate tax computation, we're going to prepare a capital allowances computation for that accounting period, and the accounting period cannot exceed 12 months. But it could be a short period there. And if it's a short period, then you would indeed need to net down that £1 million 12-month limit figure. So we'll give the 100% AIA, but if we go above the £1 million or whatever the revised limit may be for AIA, that on that excess that we've not been able to claim 100%, good news. Instead of only being able to claim a 6% WDA, we instead get a 50% first year allowance. Again, If such expenditure exceeds the AIA limit, as we've said, are 1 million for the 12-month accounting period, then the excess will be eligible for the 50% FYA. So if we had, for a 12-month period, 1.2 million spend on special rate pool expenditure, we've got our £1 million AIA limit, get 100% of that million, the remaining 200,000, FYA 50%, take 100,000 first year allowance. The balance of 100,000 that remains, you can't have the 6% WDA on this accounting period because you already had AIA and you've had FYA. You won't also there get the WDA, but that 6% WDA will be available from the next accounting periods onwards. And there we go, the remaining 50% being allocated to the special rate pool, where that reduced rate of WDA of 6% will be available from the next accounting period onwards. As we've already said, if you did buy second-hand plant and machinery there, that is not eligible. Only new plant and machinery is eligible for the 100% FYA, so that, if necessary, would continue to be eligible for AIA. Unlikely issue in terms of an exam question, to be fair, but that would still rank for AIA. The qualifying expenditure otherwise falling into the main pool, as we've seen, the 130% super FYA deduction should be claimed, of course, rather than the 100% AIA. So all the main pool expenditure that qualifies, we're not going to take AIA, we'll take the 130% super deduction. You don't get that on special rate pool expenditure, so in which case we take the AIA on it first. But if we go over the AIA limit for that accounting period, then we've got 50% FYA. But we won't get the 6% WDA until the next accounting periods onwards. There are specific rules, and awkward little rules indeed, that deals with the disposals of assets that attracted these enhanced capital allowances, but thankfully not to be examined in our Tax UK examinations there. We have a little illustration here to introduce you to. You know that at the end of each chapter you also, at least I hope you do, go to the Finance Act 2021 technical article, where of course that particular content is referenced within that technical article. And the examining team have written, this is new, you need to know it, or this has changed, you need to know it. And here's a little example or examples that deal with it. They kept their example on this new area incredibly simple. All it was here's main pool expenditure that now qualifies for the super deduction. So it was that amount at 130%. Here is special rate pool expenditure that exceeds 1 million. Therefore, take the 1 million, 12-month period, take the £1 million AIA, and on the balance then, take your 50% FYA, but no WDA being available. It was as simple as that. We brought one new component into this illustration, and that of course is that we may have balances on a pool or pools brought forward from a previous period. Balances upon which only WDA of course would now be available. So what I've got here is an example where we've got to prepare the capital allowances claim computed for the year ended March 22. Now, once upon a time, i.e. until this Finance Act and the exams from June 22 onwards, at least for a couple of years, the format of CA computation that we would use would be the same as that which we had for the unincorporated trader. Not now. There's so many issues now about the introduction of these enhanced capital allowances that do not lend, I think anyway, that particular form of presentation particularly well. You could do it, I could come up with a system that did it, but that would make life rather more difficult. Let's keep things simple. So what I'm going to do is what the examining team have done in terms of their example. And instead of working down the page in terms of what qualifies then for this allowance, that allowance, or any other allowance, I've looked at each category of capital allowance that would be available and shown it laterally across the page. So what have we got here? We open up with a tax written down value of plant and machinery in the company's main pool, £100,000. We've got 0 on the special rate pool. During this year ended 31st of March 22, we purchased new plant and machinery costing £300,000. Now again, if it's going to be special rate rather than normal main pool expenditure, they're going to tell you exactly what it is, and that's what happens next. New long life assets at a cost of 1.4. So that 300,000 there, of course, we're going to get our first and hugely beneficial enhanced capital allowance, the first year allowance of 130%. On long life assets, that equals special rate pool expenditure, and that means we'll claim our AIA, 12-month period, so that will be 1 million, but we've spent more than that, we've got 1.4 million, plus we'll then have a 50% FYA in relation to that excess 400,000. The remaining 200,000 would go to the special rate pool. We now need a special rate pool here. There was 0 brought forward. We didn't have one up until this point. But that would now be created. No WDA this period, as we've said, but next period we'd start to take the 6% WDA. So what have we got here? There's your FYA of 130% on the £300,000 of qualifying spend for normal plant and machinery. So 390,000. Now our special rate pool expenditure, but of course we're governed by that maximum AIA of 1 million. So we take the 1 million on the excess of 400,000, 50% FYA, and there's your £200,000 first year allowance. That remaining special rate pool expenditure of 200 would attract the 6% WDA from the next accounting period, so there's nothing else here. What we did also have, however, was a main pool. That was 100,000. The expenditure this accounting period has either gone for the 130% enhanced capital allowance, the first year allowance, or it's gone for the AIA, 1 million, or the other enhanced capital allowance, the first year allowance of 50% on the special rate pool expenditure. So all of that has been dealt with. So all we've got here is a tax written down value brought forward on the main pool, where there's been no further additions to that main pool, and there's no mention of disposals, so it's just 100,000 at your normal 18% rate. If there had been a special rate pool tax written down value brought forward without any additions or disposals, it would be at 6% per annum. So if, of course, there were disposals, then those with that sales proceeds to a maximum of original cost would need to be deducted. So here, if we had disposals of normal plant and machinery that had been main pool expenditure, we take the sales proceeds to maximum original cost away from that before taking the 18%. There could, of course, be some additions as well. So the main pool, and if necessary the special rate pool, might need, though I doubt this, certainly I doubt it in terms of a Section A 2-mark objective testing question anyway, but we've got your main pool in this example. We had a tax written down value brought forward. There were no additions to that pool, there were no disposals, so we just take an 18%. If there were disposals, as we have said, we'd take those out. If we had a special rate pool, tax written down value brought forward, we'd pick it up. Any disposals, we'd take that out. Sales proceeds to maximum original cost. The only thing is that what you would also have to do here, if such additions existed, additions where there would be no AIA that was available thereon, then what we would have is the additions going in before taking out the disposals, for then taking your 18% on your main pool, 6% on your special rate pool. So what additions, therefore, don't attract any of the enhanced capital allowances that we've already spoken of, and they don't attract AIA. Now that does take you back to what you saw in Chapter 5 on the unincorporated trader. And that, of course, coming into the categories here of these additions, we'd be talking about cars. Where the separation would be, we know that they are not zero emission, because if they were zero emission, what do we get? 100% FYA. So they have emissions. Now they are low emissions, do not exceed 50 grams per kilometre, then they go into the main pool. So you'd be adding them in there. If those CO2 emissions for a car exceeded 50 grams per kilometre, then that's special rate pool expenditure, and that would go in there. Upon which, again, the relevant 18% on main pool, 6% on special rate pool, writing down allowance would be available. So again, I would keep this computation, these workings on a lateral basis, using only what you need to use out of that, and pretty much guaranteed, if it was Section A, that there would be the 130% FYA, and you'd probably have AIA expenditure on special rate pool that exceeded 1 million. So you got your full 1 million, then you got your 50% FYA. They could make that a bit more interesting by making it a short accounting period, so it's down from 1 million. 6-month period, 500,000 instead of a £1 million annual limit. Those will be there. If it was Section C in the corporate tax computation, where they put a more detailed capital allowance computation in, then of course we're going to get marks allocated for each part of this. So it's ever so easy, as we have just seen, in relation to the 130% FYA. It's ever so easy for the special rate pool expenditure, up to your maximum limit, 100% AIA, there above 50% FYA. But if we had to deal with a main pool or a special rate pool balance brought forward, then we'd be doing workings that weren't as simple as that one, 100,000 at 18%. It would be the 100,000 plus any additions of the lower emission cars minus the sales proceeds on your disposals there. The special rate pool, again, tax written down value brought forward, add in, if there were any of those higher CO2 emission cars, take out your proceeds, get your balance there on at the end of the period, and take your relevant either 18% or 6% annual writing down allowance. Again, of course, watch out if the accounting period is a short one, i.e. less than 12 months. So we've got, therefore, some significant changes in relation to capital allowances. And again, where things change, as we've said probably by now many times before, that's going to be an immediate target in terms of examination questions coming up over the next round of examinations. Whether that's in the first one, the last one, all of them, some of them, I don't know. But at some point within the round of examinations, those rules are most definitely going to be tested. We need to know. So it's a different form of presentation of the capital allowance computation than we use for the unincorporated trader. But I think doing it that way is sensible on behalf of the Tax UK examining team. They've shown it in that format. I do that format as well. Okay, well, that's the new bit now that we've had to insert here for Finance Act 2021. And now back to the older lecture where things haven't changed. Over to you. Once you've got the tax adjusted trading profit, the corporate tax, it is very easy. You simply include it within the corporate tax comp. The corporate tax computation is being prepared for the accounting period. The accounting period is usually the same as the period of account. Chapter 17 deals with the one situation where those two are not the same, and that's where you have a long period of account. You may recall we said this in the first lecture. That long period of account, more than 12 months, it becomes two corporate tax computations, two accounting periods. One for 12 months, the second for the balance of months through to the end of that period of account. And what that means is we don't have any of the problems that we saw and no doubt you agree to be problematical, about Chapter 6 of how do we relate for the unincorporated trader the tax-adjusted trading profit of an accounting period, an accounting period end chosen by that trader. How do we then relate that to the period for which an income tax computation is prepared, which is very specifically the tax year, 6th of April to 5th of April there. That had to be done for the tax year. So you could have different accounting dates. You could have a startup situation, opening years, cessation situation, closing years, or an ongoing business. And you had those differing bases of assessment. Normal CYB, opening years, closing year rules. None of that problem exists here in corporate tax. We are preparing the corporate tax computation, not for a financial year, one of the three definitions you need to know, of course, for corporate tax, but we're preparing it for the accounting period, and that will be whatever accounting year-end date that company has chosen. So that means we don't have a problem relating the period to the period for which the computation is prepared. The computation is prepared for the company's accounting period. End of story. Not for the financial year. So no problems. Right. That will sort out your trading income figure, which of course is likely to be the main figure that features within a corporate tax computation. But we said there's other income, worldwide income and gains. Now, what other income might we have? We've already mentioned about interest, interest payable, interest receivable. So interest receivable, less as we've now seen any interest payable on non-trading loans, that interest receivable figure will go into your corporate tax computation. Property income. Now, what's going to happen here is that, unlike in income tax, where we mostly worked on a received basis in terms of relating a source of income to the tax year in which it would be assessed, now in preparing the corporate tax computation, we're going off the financial statement of profit or loss that's been prepared on an accruals basis. So we work on an accruals basis as well. So it will be the interest receivable. It will be the property income accrued for the accounting period there. You do not, of course, see dividend income. Dividends received from other UK and overseas companies are not taxable. Dividends paid are not deductible there. They're outside of the taxation system. So we've got interest income, we've got property income, both being included on an accruals basis, in line with the figures within the statement of profit or loss itself. We've then got net chargeable gains. That, simply from what you learnt in personal tax back in chapter 12, is for the accounting period. So this time we're relating capital disposals for capital gains on a date of sale basis. What was actually sold, what gains were realised within the accounting period. There's no accruals basis there. Did you sell within the period or did you not? And on some of those sales, yeah, we will hopefully make gains. On others, we could make losses. Net gains, so if we've got more chargeable gains than allowable losses, that is what you include within the corporate tax computation. If on any source of income like interest or property income, again, it's possible there may be more outgoings than incomings. There therefore may be losses. Wherever there are losses, whether it's capital, as we're discussing here, or whether it was on interest income, it might seem unlikely, but it's possible, though not within our syllabus. Property income, yeah, that is possible. There we may have more expenses incurred on the properties that we let out than income that comes in on our accruals, our receivable basis. If there are losses, just as it was for trading, there will be a nil assessment. And we separately deal with, as I say, the only one of these in the syllabus for us, property income. We separately deal with the rules for the use of property income losses. That gives you total profits from which, if they've been paid, qualifying charitable donations deducted on a paid basis. There, any such qualifying charitable donations paid, they will be allowable deductions to give you TTP. Once you've got the TTP, whatever accounting period end date it may now be, given the fixed 19% rate that we've had over the last 3 financial years, then it's just taxed at 19%. Before we come to the detail of how we get the property income assessment and the interest income assessment there, just a couple of points in relation to royalties. Basically, if you own a patent upon which you receive royalty income, or you use a patent in your trade and you pay a patent royalty thereon, that would be viewed to be a trading transaction. Therefore, royalties payable, relief would be given in line with the accounting treatment, so again on a payable basis, and they would be allowed as a deduction when calculating the adjusted trading profit. So there's no add back, no adjustment required. That is a trading profit expense that we've incurred. Royalties receivable, again, would be viewed that the patent that you own is being held as a trading asset, and therefore royalties receivable will therefore be included within the adjusted trading profit, with no adjustment being required. So we can get our tax adjusted trading profit. What we've just seen is, so what about property income and what about interest income there? How do we deal with that? Property income. Again, a whole lot simpler than were the rules that we had to go through in terms of income tax. As per individuals, though, with some notable exceptions. So the same basic rule of what do we allow as allowable expenses in relation to property income will remain the same. The one big difference, and something that you'd need to look out for, is that if interest payable was on a loan taken out to buy a rental property, that is fully deductible against interest income, not property income. So all non-trading loan interest payable is a deduction from the interest income assessment. It's not a deduction against trading income, and in relation to a rental property, so not one that we use within our trade itself, but a rental property that is investment, that income would be property income, and the interest payable, instead of, as it would have been in income tax, a deduction against the property income. No, not here. All non-trading loan interest is a deduction against the property income. That's said to be under the so-called non-trading loan relationship rules. The restriction that applies to individuals on finance expenses does not apply in corporate tax. So again, in corporate tax, whatever interest was payable on loans taken out to buy and or improve rental properties, then such interest is tax relievable, but not against trading income, instead against interest income. Not property income, not trading income, against interest income, remember. And obviously with a company, there's no renter room relief for companies, of course, there. If a company should incur a property business loss on its overall properties, it has more expenses than it has income, then it must be offset in full against total profits, which of course is before deduction of qualifying charitable donations of the current period. So if we get a property business loss, there are more expenses than there is income. On that basis, the loss creates a nil assessment on the face of the corporate tax computation, but that loss must then be offset against total profits before the deduction of the qualifying charitable donations of that current period. That would mean that if that loss was bigger than that total profit figure, it's unlikely that that would be the case, but if it were, then there's nothing to deduct the qualifying charitable donations from, so any unused donations paid would be wasted. Either you get the relief in the current period for the donation paid, or if there's nothing to deduct it from, there are no total profits that remain to deduct it from, then it is wasted. There's no tax relief. You can't carry it forward, you can't carry it back. The property business loss, however, that you have sustained, if any of it is still unused, though you cannot carry it back, it can indeed and will indeed be carried forward. Any excess property business loss is carried forward and set off against, note now, any part of the total profits of the company. So here, when you carry forward, partial claims may be made. So you don't have that problem that if that loss was bigger than the total profits, it would bring the total profits to nil, and then there'd be nothing to deduct any qualifying charitable donations paid from. That's not going to happen, because now you can pick and choose on a carry forward of a property business loss how much of that loss is used against total profit. So what you would do therefore is to restrict that claim such as to leave sufficient total profit to absorb the qualifying charitable donation paid. But you can't do that in the current period. Again, no partial claims in the current period. It's offset in full. No partial claims in current period, only when you carry forward. Interest income, as we've already said, we're working as with property income on an accruals basis, so it's all interest receivable, is assessed as interest income. Companies receive all interest gross, basically nowadays, as do individuals, at least so far as our syllabus is concerned. Interest payable is deductible against tax adjusting trading profit if the loan is used for trading purposes, as we said, for example, to acquire property or plant and machinery to use within the trade, or to increase working capital. If the loan is used for non-trading purposes, then it is deductible, yes, but against interest income, not against trading income, not against property income, but against interest income. Again, on an accruals basis, the interest payable, and what are our main examples of non-trading loans? Those taken out to acquire a rental or investment property there, as stated above, or to acquire shares. If you buy shares, whether that's in a subsidiary company or just a minority interest in a company, it doesn't matter. If you borrow to buy shares, that is a non-trading loan, and the interest payable is a deduction against interest income. Last couple of areas, qualifying charitable donations. For companies to ensure tax relief is achieved on their charitable donations, they should make such payments under the qualifying charitable donation system. You will be told that it is a qualifying charitable donation. That payment is gross and deductible on a paid basis. So in the adjustment of trading profit, any such payments should be added back. Remember, in the first part of the exercise, you're deriving the adjusted trading income. If something is not an allowable expense against trading income, but has been deducted in deriving the accounting profit from which you've started the adjustment of profit exercise, then you must add it back. It's not allowable against trading income. But instead, you will give the deduction, well, where it should be. If it's a qualifying charitable donation, it's included as a separate deduction on the corporate tax computation. As we saw a moment ago, if you've got interest payable on a loan taken out to buy a rental property, then that would go against interest income. We find the correct slot to give tax relief for interest payable, we find the correct slot to give tax relief for qualifying charitable donations that have been paid there. Dividends. Dividends received from UK and overseas companies are exempt corporation tax and never included as a part of taxable total profits. Now you'll notice here that we've gone to each individual source of income, determining whether or not it is a part of TTP or not. We have merely mentioned the existence of capital gains. We have separate chapters here in corporate tax that deal with chargeable gains. So again, at this point, it'll just be, here's a capital gain computed for corporate tax. Here is allowable capital loss computed for corporate tax. We don't have to worry how we derive that figure, though it is mostly, though not entirely, the same as what we saw in personal tax. What we'll do when we get to the capital gains for companies chapters, that begins on what's chapter 19, I think it is, then you'll see how it is specifically that we deal with the computation of a gain in particular, so far as companies are concerned. And you may recall from the studies of personal tax, CGT for individuals, that for companies, we get an extra deduction, or we may get an extra deduction against our capital gain in relation to something called indexation allowance, relief for the effects of inflation. But that's not a problem for now. That awaits you in chapter 19. So, all that's left for me to get you to do now, therefore, is to have a go at example 1 between now and next time and check that answer out for yourself. Should be a straightforward exercise, so no pressure then, eh? Compute the TTP for the year ended March 21. So we're not calculating the corporation tax liability. That would be 19% of that figure. We are computing the TTP. What have we got? There's the tax adjusted trading profit. If I've given you adjusted profit and separately capital allowances, then of course you would take the capital allowances from the adjusted profit to give you the tax adjusted trading profit. So that will be the first figure to go in. We have property income taxable within the corporate tax computation, interest receivable taxable within the corporate tax computation, chargeable gains less capital losses taxable within the corporate tax computation, dividends from UK companies, whether indeed it was from UK or overseas, but overseas issues are not as such a part of our syllabus. Dividend income is exempt. Qualifying charitable donations there, that of course is an allowable deduction from total profit in deriving then what will be TTP. Again, no need for you to worry about putting that down in detail there. If you just run through, again, just in rough, what that would be, check it out with the model answer. I'm sure there won't be a problem. Next time, what we'll discover is that now we know how to prepare a corporate tax computation for an accounting period, where the accounting period has been the same as the period of account. What happens in that situation where the period of account is actually longer than 12 months? Therefore, rather than one corporate tax comp from one period of account, we have to prepare two corporate tax comps for two accounting periods from that long period of account. Again, it's not a long exercise, but it's something we'll see within our next chapter together.